With a good year in the stock market comes the appropriate warning. That's a tax warning. Watch out for capital gains taxes. I'll explain how to do that and more coming up. My name is Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Hopefully you have a tax shelter strategy. We talk about that all the time. One of the 6 areas of your financial life is tax planning. So what are the opportunities for you to pay the least amount of tax over your lifetime and ensure that you are using those creative strategies to achieve that, whether it's, just less tax over your lifetime or even multiple generations. And part of that is having the right tax shelter strategy. Should you be funding Roth IRAs, your Roth 401k? Should you do Roth conversion? Should you do HSA? Should you do pre-tax? All that sort of stuff. But if you're saving up dollars above and beyond those tax shelters, or maybe you inherited some dollars or sold a business or some real estate, and you've got some dollars that you've accumulated or you're investing outside of a tax sheltered account, maybe a joint account, an individual account, a trust account, something like that, you've got to watch out for capital gains. Now, there's 2 different types of capital gains or capital gains that you need to be worried about. There's the obvious ones, and then there's the hidden ones. And the hidden ones oftentimes can be even more dangerous, even more frustrating, but here's the catch. They can often be avoided. Let me explain the obvious one first, and that is outside of these tax shelters, right? So in an individual account, a joint account, say you buy an investment, and that investment, you paid $10 a share, and it grows to $15 a share. Well, if you don't do anything, if you just say, oh, that's great, and you see the appreciation on your statement, that's an unrealized capital gain. But you didn't sell anything, you didn't do anything, so it's not taxable to you. It's not taxable until you sell it. Let's say you wait until it reaches $25 and then you sell it. Well, in the year that you sell it, that's when you have to report the gain, the difference between the $10 that you paid for it and the $25 that you sold it at. So the $15, you've got to report that as a capital gain on your federal tax return. And if you held that investment for less than 12 months, it's a short-term capital gain, and that income or that gain is going to be taxed at your normal ordinary income tax rate. So, 10%, 12%, 22%, 24%, that sort of thing. If you held that investment though for more than 12 months or more, then it's a long-term capital gain, and long-term capital gain rates are at a favorable rate. Okay, so you definitely want to be aware of your holding period during this obvious capital gain tax planning. If you're in the 0%, 10% or 12% federal tax bracket, then that capital gain is 0. Those long-term capital gains, that's 0% federally. If you have if you live in a state that has state tax, it's likely going to be taxed at the state level, but not at the federal level. If you're in the 22% tax bracket or above, up to a certain limit, then your capital gains tax rate is 15%. Yeah, again, so that's obviously higher than even the 12% tax rate, but 15% is better than the 22% rate or 24% rate that you'd otherwise be at. So it's a favorable rate. If your income it reaches a higher threshold, $500 and some $1,000, then your capital gains rate goes to 20%. But again, it's a favorable tax rate. But these are the obvious capital gains, and you have control over them. So some tax planning could be, I'm trying to capture some capital gains. These are investments that I want to diversify or capture some gains, and this is a good year to pay the tax on it, so I'll harvest some gains. Or you might have some investments where there's actually a loss, and you might want to sell some of those losses to offset capital gains. There again, you've got some tax planning work at your fingertips. Just a note, even for these obvious ones that you're aware, hey, I did sell something, there's no tax being withheld on that. So if you, I know I'm going to have some tax on that, and I'm going to be in the 15% long-term capital gains, so I know the tax is going to be X. There's no way for you to withhold taxes when you sell a stock or sell an investment. So you might have to pay in an estimate. You might want to do some other kind of creative withholding strategies, or just be aware you're going to owe some tax when you file your taxes. But That's all the realized capital gains, and those are the obvious ones. Now the hidden capital gains, like I said, those can be more dangerous or feel more punishing, and it's because they're hidden. In this instance, we're not talking about realized capital gains, we're talking about capital gain distributions. So going back to that example, say you bought an investment at $10, but that investment was a mutual fund. If you bought a mutual fund and you bought it for $10 a share and you owned it and it grew to $25, or excuse me, it grew to $15. Let's use that as an example. But you don't sell it, there's no realized capital gain. But within that mutual fund, what you don't see and what is hidden from view is while you own shares of that mutual fund owns shares and shares and shares, lots of different stocks, lots of different investments under the hood, within the mutual fund. And you can't see all of the buys and sells that are happening within that mutual fund. It's possible that mutual fund maybe bought Apple way down here, and earlier in the year, it sold it for way up here. Well, now, because within that mutual fund, there was a capital gain because it bought something for a low price and sold it for a high price, that capital gain gets passed through to the shareholders, the owners of the mutual fund. Mutual funds are what's called a pass-through entity. They don't pay tax themselves. They pass along that net capital gain activity onto the shareholders, and on your tax form, you get a statement saying these are the capital gain distributions that you're responsible for that land on your tax return. This can be a very frustrating experience and is very likely to occur in years like we're having right now, where the stock market far surpasses expectations on the high side. It's very likely that actively managed mutual funds, maybe the managers saw, hey, this is a good time. We've made a lot of profit on this individual stock position. Let's sell some shares up here. Or maybe certain stocks really ballooned in value and now they take up a larger than normal or larger than ideal percentage of the overall mutual fund, and the manager wants to start selling some of those shares to trim some of that position. You don't see that at the time. You're not made aware of those decisions until you get your tax form, and there's this big capital gain distribution that you now need to report on your tax return. If that's the case, then yeah, there's just like in the obvious example, there's no tax withholdings that you were able to do on that. And so therefore, you might end up having a decent amount of taxes to pay and face a tax surprise simply because you weren't aware of this capital gain distribution and now it just lands on your return. If that's you, do the proactive tax planning, working with your CFP to try to estimate what that could be and estimate, well, or make some assumptions on, well, how could then we pay in our taxes to be sure that we avoid a penalty and avoid any surprises. But there is a way to almost avoid that hidden capital gains tax, that hidden capital gain distributions. And that is, instead of owning an actively managed mutual fund, instead own an exchange traded fund. An exchange traded fund has a lot of similarities as mutual funds, but a few distinct differences. And one of those is it has a favorable tax treatment. Within that exchange traded fund, the manager, again, could be buying and selling just like they were in that mutual fund. However, very, very rarely, in prospectus or by structure, it's possible they could distribute a capital gain distribution, just like the mutual fund. But rarely do they, because of the unique way in which they are set up. So oftentimes, you can avoid this hidden capital gain distribution, this hidden capital gains tax, by owning exchange traded funds instead of mutual funds. If you've been an investor for a long time, you might have some old mutual funds back before a lot of these exchange traded funds were prevalent, or the types of exchange traded funds that you want to invest in maybe before they were available. And you might own some mutual funds that now you really can't move out of because there'd be a big realized capital gain. But for those of you for investing new dollars outside of these tax shelters, set yourself up so you avoid these hidden capital gains distributions by owning the right exchange traded funds as you're building out your investment portfolio. Work with your certified financial planner on this year's tax planning, and if you do have dollars that you've accumulated that you're saving up into outside of your tax shelters, make sure you've got a plan and a strategy to manage or minimize the capital gains that you could face. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with KWiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.